I come from a very middle class family uh, that lived paycheck to paycheck. It was only when my father fell sick, he did not have health insurance. Very quickly, we found ourselves in debt, and we owed about 3 lakhs to my brother in law. And I realized that you need to invest in equity.
Sir, if there was a rule of withdrawal from your corpus, what would that have been?
I would say it should be less than 3.5%. Any hit in the market or any course run in the market, initially, the first 10 years, 15 years of retirement, then you are in trouble.
You were to give a investment strategy to somebody who is 25-year-old or a 35-year-old or a 45-year-old, what would that have been individually?
I think there's a saying, paisa se paisa banta hai. If you suddenly don't like your boss, you can say, to hell with you, I'm going to go. You don't need to wake up the next Monday and go to work.
Hello, Patu sir. Thanks for doing this with us. There are a lot of people whose fire journey we have been sharing, whose financial independence journey we have been sharing, and we have been taking a lot of inspiration from. And I think you are one of the people whose journey should be shared, and people should know about it so that they can take inspiration, and at the very same time also try to derive their own path in terms of how they can achieve their financial freedom based on your journey. So to begin with, sir, so what is your journey? What's been your journey like? How did you choose to, think about financial freedom? At what age did you realize that, now I should be achieving financial freedom? What has been your professional journey been like? Walk us through the entire journey that you have lived so far.
Yeah. So first of all, I'm happy to be here. Thank you for the opportunity. And my journey towards financial freedom or independence, whatever you want to call it, it's more accidental, I would say. I did not have any particular goal uh, to be financially free by some age or to have X amount of corpus or whatever. I come from a very middle class family uh, that lived paycheck to paycheck all its life. So that means by the 20th of each month, my father and mother would feel the pinch, and they would be awaiting for the next salary. That's the kind of very simple existence that we had. And since I chose the academic path, uh, there was no way I was seeing big money until I actually got a tenured job. So I got a tenured job only in my 30s, my 32, 33, I got a
All right.
proper job. So from school to that was a journey of about 12, 13 years. And during this period, I was not really seeing any big money. It was only a scholarship amount, a stipend that I got
Correct.
for my PhD, a little bit for during postdoc, etc. And so on. And I did not know anything about financial uh, ideas of financial principles, investing, personal finance, nothing at all, because I was completely steeped in my work and knew nothing about it. It was only when my father fell sick due to a form of cancer called multiple myeloma that I realized that I had to learn money management overnight. And since he did not have health insurance and I did not have any big resources to speak of, very quickly we found ourselves in debt, and we owed about 3 lakhs to my brother-in-law at that time. About
What age were you, sir?
This is 2006, 7, so I would have been what late 29, 30
Okay. Okay.
approximately. Things were pretty late. I was a very late investor. I mean,
Right.
because I did not even know anything about investing at that point in time. I was a big
No,
zero.
no, sir. The reason why I'm asking this is because on the internet, everybody talks about they talk about that we should start early and then only we can achieve financial freedom. But I think that is not the case. Whenever you start, it's important for you to start. It's not the age that matters, but the realization matters. If it kicks in early, it's good enough. If it kicks in late, that is also not bad. So maybe yes.
Yeah, there's no place for regret, but also I would say that starting early is fine, but if you spend most of your 20s in upskilling or getting yourself a higher degree or trying to get yourself a higher income, whatever it is, and let's say you settle down by 29, 30, 31, 32, something like that, you can still catch up for that so-called time lost because you are going to be able to invest more. Your salary would be much higher than somebody who started with a much lower qualification at age 22, 23 or whatever. I've
Correct.
just after UG. So starting early has to be taken, in context. it has to be personal. That is, everybody should start as early as they possibly can. For
Correct.
right,
I-
so it's a personal acting.
Right. I think you've put up very correctly.
Yeah. So in my case, I started my so-called financial journey with debt, and that was a kind of a very bad point for me. That was one of the lowest ends for me. But I found myself 3 lakhs in debt. I had experience going abroad twice. By that time, I was a PhD, and I had just started my career at IIT Madras, and I said, so after all this education, after all this work, and I'm going to start myself in my life in debt. What use is this going to be of? And I told myself I should never find myself again in such a position. Not going to get myself into debt, and that is where the goal-based investing idea came into me. Because I told myself, if you sat down and listed all the bad things that can happen to you, or all your needs and all your wants, you can prepare as much as possible for them. And it will not come as a shocker, right? I mean, it'll start, suddenly you wake up and say, oh, there's a big expense coming in 2 months. I have to prepare for it. You can't prepare for it in such time. So typically what people will do is they will redeem whatever investments they are holding, or they will borrow. They'll do some kind of things that they will use their credit cards to, and postpone the debt and payment of the debt and so on. So all those things I did not want to do, and I wanted to streamline my personal financial affairs. Of course, it took a lot of time. So I was in debt in 2006, 2007 again because of his illness, but only in 2008, 9, maybe even later, I would say, when my salary increased, because of the pay commissions and government pay commissions and so on. It is only at that time I was able to repay back. So
Right.
it was quite a long time. And during this period, I was trying to learn about how to invest. And uh, in hindsight, one good thing about me is I don't ask XYZ what to do. I
Okay.
just try to learn on my own.
On my
Thankfully,
own.
internet was already there, reasonably established by then. So I was able to dig up. Of course, it was a lot more tougher then to dig up information than it is today. Today, probably it's an overload everywhere. But it was, so I was DIYing this. It took a lot of time, and I realized that you need to invest in equity, a good amount of your investment in equity. And I started my journey with mutual funds in about June 2008 with a small SIP of $1,500 a month. That was how my journey started. At that time, I did not know anything about the Lehman crisis, etc. The global financial crisis that was going
Crisis.
on. I had no idea. It was a personal thing for me that I had to start. I started. That is all. It just so happened that in the next 5 years, the market went nowhere. And from 2008 to late 2013, I got no returns.
Right.
I told myself, look, I have 30 years to go for my retirement. I'm not really going to worry too much about uh, what's going to happen today. So let me just wait it out and see the bad phase. And I was also able to increase my investments gradually, because the more and more I got comfortable with the idea of investing in equity, and I realized that if you want to beat inflation and to be financially independent over the long term, you need a good chunk of equity in your portfolio. So I was able to
Right.
invest. And in 2013, when the market took off, my portfolio also took off. Right? So that
Right.
was a big difference. That was a big change in me, because that was what changed my social station.
Correct.
At that time, I was completely debt free, and I was also able to increase my wealth. It is
Correct.
only I would say 2017, 18 or so, I kind of stopped to look at what my portfolio was. I usually have this habit of not worrying too much about what my returns are, or worry too much about reviewing the portfolio. I used to just keep investing,
Correct.
like a man. So people around me were talking a lot about fire, about fat fire, thin fire, all kinds of. You go to Reddit, you get all kinds of weird kind of abbreviations for this, and most of which I still don't know. Uh, I keep these things simple, but and then I thought, okay, let me also find out what is my so-called retirement corpus worth and so on. I realized that I had hit 30x then. So X was my current annual expenses and my retirement corpus was 30 times that.
It's
So
a
that was
general thumb rule of fire,
threshold of financial independence. You're
right?
not ready to retire at by 30x. 30x is too small. Many people will disagree with me, but 30x is too small. When there is a bull market, people will disagree. When there's a bear market, they'll say 30x is not enough. So that's how people behave. So, 30x was there at that time. I was okay with that, and then I started investing probably more. I would say because
Correct.
my income increased, and
Correct.
so I kept going. And that
Right.
was the simple journey. It was basically uh, propelled by systematic investing. That is all.
What is the percentage allocation, if you do not mind sharing, between mutual funds and direct equity?
So my overall equity allocation on date is about 66% or so.
Okay.
Uh, Probably it's a little, I'm 50 now, so probably I should start decreasing it going forward, but it's about 66%. And out of that, uh, it's about 8, 9% only is directly.
Okay.
The rest of it is all is prime, mostly mutual funds.
Okay. And what about the rest 34%?
Yeah, so that is the dominant part is my mandatory NPS,
Okay.
the government allocation. So the government allocation is 85% of gilts and 15% of equity.
Okay.
And uh, that's my so I treat it as a more or less a fixed income kind of portfolio. A little bit of PPF, just that's all.
So for the audience, can we talk a little about guild funds, what exactly they are?
So a gilt fund is basically a debt fund that holds government bonds, predominantly government bonds. So, for those who may not know anything about debt funds, a bond is basically like a fixed deposit. So you give some money to the bank, and the bank takes that money, deploys that capital, and in return they will give you interest at regular
Correct.
intervals at the end of the tenure.
Correct.
The same thing is how a bond works. In a bond, of course, the interest is given twice a year. The annual interest is divided into two and given out twice a year. The catch is that this bond is tradable. In a fixed deposit, it's not tradable. It's a very stable thing. You know how much money you're going to get at the end of the period. You know how much is the interest, etc. Everything is well known. But in the case of a bond, this part is well known, but it is tradable. And the moment it is tradable, the value of the bond itself will change because of supply and demand.
Correct.
So, therefore, for a debt mutual fund, the NAV of a debt mutual fund is marked to the actual market value of those bonds. And
Right.
therefore, the NAV will fluctuate up and down.
Right.
Now, the longer the tenure of the bond, no matter what bond it is, whether it is a corporate bond or a gilt bond, no, the longer the tenure of the bond, the more will be the price fluctuations because the more is the uncertainty in the future interest rate.
Correct.
Whereas it's a very short term bond, 2 months, 3 months, then people don't care too much because anyway, in 2 months, the bond is going to end. After that, you can buy a new bond. Whereas
Right.
if you're going to hold a 20-year bond, during that period, the interest rates can go up and down two, three, four times. So you
Right.
don't want to be holding a wrong bond for offering low interest rates when the actual interest rate is higher, current interest rate is higher. So therefore, the price will fluctuate a lot more. The demand and supply forces will be a lot more for long-term
Longer
bonds.
bonds.
So a gilt mutual fund typically holds bonds about 5 years or more than 5 years.
Okay.
Today we have gilt funds up to 50 years.
Okay.
So 50-year bond will be extremely volatile.
Correct.
Not
And
vol-
what kind of return can we expect?
So this is something that it is very hard to predict returns for any capital market, whether it is equity funds or gilt funds.
Correct.
You would typically, I would say, if you hold a gilt fund for a long enough term, let's say about 10 plus years, there's a reasonable chance you can beat a FD return over that.
Okay. Okay.
That's
And
the
also we can beat inflation with that.
no inflation would be hard because you have to pay taxes
Right.
and beat
Okay.
FD, but after taxes, it would kind of, if you're lucky, it would match inflation at best. Probably you
Okay.
end up with a zero real return. But even that is,
Okay.
there are uncertainties.
So given that you have accumulated the kind of corpus that you have, do you still feel the need to go to work, or you're retired?
No, I'm not. I mean, of course, I'm not retired. My retirement is another 15 years away, technically speaking.
Okay.
I have a 65 is my retirement age, but I love what I do. I
Okay.
teach, and that keeps me alive. And I'm going into a room filled with intelligent people, more
Right.
intelligent. There's a saying that if you are the most intelligent person in the room, you are in the wrong room.
Correct.
And I'm always in the right room. I'm guaranteed to be in the right room because I'm going to a bunch of these sharp kids who are way more intelligent than me. They're quick to grasp concepts, and most often they teach me what
Right.
to do and how I'm explaining it wrong. So it's a wonderful experience for me. And they also like somebody, one thing about teaching is you got to be honest. If you don't know, you should say you don't know. If you kind of
Correct.
fudge around and say this is how it is, and then the students will understand you're not good enough. So
Correct.
it's a wonderful learning experience for me, and so I'm just going to do it as long as I possibly can.
So, since sir, you are working currently, what exactly is financial independence for you, and what exactly FIRE is for you?
Uh, it is an option. That's how I look at it. Because if something happens to me today, my family will still would have achieved fire. My wife doesn't go to work currently. But if something happens to me today, my wife will not be forced to go to work because my income is not there. She would have achieved fire. So in
Right.
that sense, we are financially independent. It gives you options, and that's always a good thing. So that's how I.
Correct. And sir, if there was a rule of withdrawal from your corpus, what would that have been for
Uh,
to make sure that you meet your consumption needs?
for in general, I would say that a safe withdrawal rate, that is the initial withdrawal rate. And for those who may not know, it is the initial expenses annual expenses in the first year of retirement divided by the value of the corpus at that time, at the start of retirement. I would say it should be less than 3.5%. That is what I would recommend. That is, if you want to even think about beating inflation, etc., then it should be at least less than 3.5%. This is for the people who are aspiring it. My safe withdrawal rate is much lower than that currently. But I would say if it is more than 3.5%, it is difficult and dangerous to manage equity after retirement, because any
Correct.
bad sequence of returns, any hit in the market, or any poor run in the market initially in the first 10 years, 15 years of retirement, then you are in trouble.
Okay. So, can we increase the rate after 10 years or 15 years?
No, see, the initial withdrawal rate is defined as the initial rate. It is the rate at when you when you retire, excuse me. So it is the first year of annual expenses divided by the current value. That
Correct.
is what. After that, even if, let us say, my initial withdrawal rate today is 3%, and I'm going to retire today, 3% is a very good number, and it's a very safe number. But even for somebody like that, the in subsequent years, the withdrawal rate will keep increasing with inflation. Because inflation is there, you're going to draw more and more. The withdrawal rate will go up exponentially. So it's always going to increase. We are only talking about the rate at the start of the retirement.
Oh,
If by some chance there is some factor of luck and you have had stellar returns after retirement, and you have some luck, you have not been withdrawing too much, your expenses have remained more or less stable, there has not been any good news or bad news, whatever it is, you man, then maybe you can kind of expand your lifestyle a little bit
correct.
down the line and withdraw more. But that is a
Correct.
contextual thing.
Right. And sir, say for example, if you were to give a investment strategy to somebody who is 25-year-old or a 35-year-old or a 45-year-old, what would that have been individually?
I think youngsters should just stick to an index fund. They should
Okay.
stick to an index fund, invest at least 60, 50 to 70% in equity, I
Okay.
would say. 50, 60, 70% somewhere in equity, in an index fund, rest in fixed income. And they should try to upskill themselves, increase the income. And
Right.
they should understand that, um, I think there's a saying, paisa se paisa banta hai. That is,
Right.
need money to make money.
Correct.
So if you want to create wealth, many people are under the misconception that if you increase your returns, you'll create wealth. But to increase the returns, you are actually increasing the risk. When you increase the risk, you are guaranteed of higher risk. You're not guaranteed of higher returns.
Right.
The way to guarantee wealth is to increase your the investment, and the best way to increase your investment is to increase your income. Of course, you
Right.
have to keep your expenses also in check, but if you increase your income, things will fall more or less fall in place.
Correct. And for a 35-year-old or 45-year-old, what would the advice be?
Probably they are at a stage in life where they may have made some mistakes down the line in the
Correct.
past, and they may have a portfolio which is a little bit cluttered. They may have one too many investments. Typically, most of them will have. And I would say if they have the time to do it themselves, they can. But if they don't, their jobs are busy, they have family responsibilities, etc., then it is best to talk to a SEBI registered fee only advisor and sort out their financials.
Right. And so currently, and so for a 25-year-old, you mentioned about index funds, and the emphasis that you laid was very high, and you said 60-65% allocation in index funds is a good allocation to have. Why not active funds? Why not small cap mutual funds? Why not mid cap mutual funds? Why not try to generate that extra 7-8% from the greater than the index?
See, my research tells me that whatever the category, regardless of what category you take, typically large cap, flexi cap, small cap, mid cap, only half of them manage to beat a reasonable representative category based benchmark index. Only half of them consistently beat it. And
Right.
therefore, I'm not sure which half I'm going to choose. Today, I'm looking at past returns. I can say ABC funds have outperformed the index. But
Right.
if I look at those returns and invest in ABC, I'm not guaranteed after 5 years those ABC will be the winners, because
Correct.
it's like a roulette. It keeps moving, changing, the things
Correct.
changing. The safest bet for me is to stay in a very stable index, like the Nifty or the Sensex. If I have this FOMO of I'm missing out on some things, then I would say choose a Nifty Next 50 index, which is more or less like a mid cap index in risk, and that will give you, if you are patient enough, that has a reasonable chance of beating the Nifty or the Sensex, and that will give you the little bit of extra effect.
Correct.
That's all. You don't need to go anywhere else. And the advantage of staying with passive funds, index funds, is that not ETFs, index funds particularly, because ETFs have got price now fluctuations and you have to worry about that. Index funds particularly is that you don't have to worry about fund manager performance. You don't have to worry about other funds are performing well. My fund is only 3-star rated, 2-star rated. I don't care about all that. I can focus on my goals, my financial goals. I can focus on my income. And most importantly, I don't need to have finance as a hobby. Many people follow financial news. They have to worry about this and market news, what is happening in the market, what is happening in mutual funds. I don't care about all that. I can have a hobby which is completely not financial. I have better work-life balance. I have a stress-free life just by investing in index funds.
Correct. And sir, like even among various passive funds, passive Nifty funds for that matter, we have now 15 to 20 options in the Indian markets as well. Any reason or any filter that you would, recommend in terms of choosing a particular fund out of those 50-20 funds, or all are similar?
I would say don't look at expense ratio,
Okay.
because a low expense ratio does not mean higher returns.
Correct.
Seems very intuitive. Most of the things in finance that seem intuitive, if you actually analyze with data, it will turn out to be the wrong way.
Correct.
So look at low expense ratio, because usually that is basically a ploy by the AMC to attract AUM. They'll keep the expense ratio low because their AUM is low. They'll attract. Once they have enough, they'll jack it up. So
Right.
you don't worry about it. Look at something called the tracking difference.
Correct.
Tracking difference is the index fund return minus the benchmark return.
Okay.
Ignore the tracking error. The tracking error is a metric that is only for fund managers. You don't need to worry about it as an investor. As an investor, I am paying the AMC money, and I'm paying the AMC money for giving me a return as close as possible to the benchmark return, the
Correct.
total return index. And that is measured by the tracking difference. And so I will look for a consistently low tracking difference. And A reasonable TER is okay. I don't want a TER which is high, very, very high. I don't want a TER which is very, very low because these things keep changing. I have no control about it. A reasonably low TER is okay, total expense ratio. And the AUM should not be too small. If the AUM is too small, how small is too small is very hard to define.
Is there a
Uh,
cutoff number for you for the AUM?
I would say at least 100 crores is better,
Okay.
but that's an arbitrary thing. That's something that I've noticed just by visually, not, I don't have any data-based evidence to back it up. And from what I've seen, 100 crores is reasonably okay because if the AUM is too low, if there is a sudden uh, influx or outflux from or into the fund manager will find it difficult to track the
Correct.
index. And therefore, you don't want a AUM which is too small. So a reasonably large AUM, a reasonably low medium-sized total expense ratio, and a reasonably small tracking difference. You can choose any fund. And usually, I would say out of those 10, 15 you had mentioned, I would say about half of them would fall under this category. And then it is inky pinky ponky. After that, you don't need to worry.
Correct.
If you, I mean, there are investors who spend a lot of time worrying because they have this fear that they're going to make a mistake. I think you should not worry too much. There's no place for regret in the capital markets there.
Correct.
Things are always going to keep changing. Just choose one and start. That's all.
And sir, in the entire conversation, you mentioned a lot of times about goal-based investing. So what exactly is goal-based investing, and if you can help us understand it with a couple of examples from your case study itself.
So, see, if let's say I want to invest, I should know when I need the money. If I don't know when I need the money, I can't decide how much risk I'm going to take. That is the first thing. Because if I'm going to need the money in 5 years, or there's a certain level of risk I can take. If I'm going to need the money after 25 years, I can take a lot more risk. Right? I can have a lot more equity. So when I need the money is the first thing that we should ask. And that defines the risk. And you can be clear about when you need money for something only when you know why you need it.
Right.
Right? If you know why you need it, automatically the when will become clear. So there are many young people who tell me that, look, I'm just starting my career. I don't have any goal. I just want to build wealth. I just want to invest. I tell them, no, you have a mandatory goal. Financial independence, financial freedom is a mandatory goal for uh, all investors, regardless of when they start or when they, regardless of age. So that use that as a goal. Tell yourself you don't need to think about retirement because for a youngster, thinking about retirement seems a little weird. Think about it as a financial independence. Think of it as an option. Like I said, it gives you an option where you have enough corpus where you can say, if you suddenly don't like your boss, you can say, to hell with you, I'm going to go. You don't need to wake up the next Monday and go to work. That kind to get to the stage where you have those options, it will take about 15 to 20 years for a normal person, typically, with discipline. Right? So that is the goal for everybody, regardless of what stage of life they're in, whether they are unmarried, married, whatever, close to retirement, far away from retirement. And then, of course, when you have children, automatically their college expenses, etc., becomes a natural goal. So it's a very goal-based investing is a very natural thing in my opinion. It's
Correct.
essentially common sense. It
Correct.
gives you a reason behind why you are investing and when you need the money, and therefore how much risk you can take. Once you decide how much risk you can take, that defines your asset allocation.
Right.
And within the asset allocation, you're going to now choose the product category. So, for example, if equity, am I going to use mutual funds? Within
Or
mutual
direct.
funds, I'm going to use ETFs or index funds, active or passive, or is it direct equity? Those kind of things. And then you go to the next stage. If I'm going to choose equity mutual funds, how much of large cap, how much of mid cap, etc. And you have sub answers. The final question you ask is, what is the actual product I'm going to invest in?
Right.
The mistake most people do is, this is the first question they ask. They don't have any of the other steps ready, but they will ask, where should I start an SIP in? Which SIP is good? So, and if you tell them to do goal-based investing, they get irritated. They want a ABC fund, direct plan, growth option kind of answer to their question. But that is the very last step. Process first, products last. That is goal-based investing in it.
And sir, one more thing that you had mentioned about, in your journey part itself, about not having an health insurance, and somehow we realize the importance of having one. Today, sir, when you are financially free, do you have any insurance policies in place, or how would you recommend it for somebody who has a family depending on him or her?
So health insurance is extraordinarily essential. I would say it is even more important than life insurance, because life insurance you claim only once. In health insurance, over a 10-15 year period, for a family of 2 or 3 people, you're going to claim at least 3-4 times.
Right,
Hopefully less, but on average, it will be 3-4 times. And that every time you go to a hospital, and these hospitals these days are basically, they think of themselves as hospitality industry. They
right,
consider themselves part of the hospital. So if you, it's a very expensive proposition to stay in an ICU for even a day or two.
right,
So health insurance is essential to protect your wealth from erosion. That is how I should how you should see it. Because a single hospitalization can change your social station. I mean, I always tell people come and tell me health insurance is a waste of money, etc. I tell them, go and sit in the ICU waiting room for 2-3 hours. You will see at least one or two people crying, and they're crying because they have to find a way to pay the bill. So that is a situation we should never be in. Of course, if I'm super rich, like I have 100 crore portfolio, and the income is also high, then I can say I don't need a health insurance. Because the maximum health insurance, as far as I know today, I think is about 1 crore. Most
correct,
typically, people's maximum is 1 crore. If my portfolio is way higher than that, I can manage without health insurance.
right,
But for most people, for the average guy, we definitely need health insurance, especially in the stage when they're building wealth. So I do have health insurance, and I have a health insurance policy from United India. So I have a base policy of about 25 lakhs and a super top up for about
correct,
19 lakhs. They don't offer a 1 crore policy.
right,
They have a 99 lakhs.
right.
And
And
it's
the add-ons and everything in an health insurance policy, I think, are very personalized. What kind of add-ons you need. It's not the case that the add-ons that you are adding in your policy should be the same for me as well.
by add-ons, you mean the critical illness. That's what you're talking about.
Correct, correct.
The
Yes,
accident in illness, insurance and critical illness.
right,
Yeah, that is right. It is a personalized thing, but we should also understand, we should have some understanding about how they work. We should understand that critical illness means it's not the medical definition of critical illness. It is the insurer's definition of critical illness. Similarly, accident is not the usual local parlance of accident. It is the insurer's definition of an accident.
correct.
Often they don't match, and people will say,
Match.
I had an accident, but they denied me claim. And so
Right,
once, if you have that understanding, and if you think that is necessary in our lives, for example, some people may have, blue collar jobs, and they may need accident insurance. So it's a very context personalized thing.
and what about life insurance, sir?
Yeah, just term life insurance.
Okay,
Don't make the mistake of defining 1 crore, because people say, I'll just take 1 crore policy. You can't keep saying, people have been saying 1 crore for almost 10 years now, 15 years now. But inflation would have eroded that by a significant amount. 1 crore in the last 10 years would have now be worth about 75 lakhs or so, not more than that. So I would say, first you have some understanding of why you need insurance, life insurance, right? You should have, because if suddenly if the breadwinner disappears, the spouse or the partner will need to handle the expenses of the family for at least until the children start earning, or it may be for the life of the spouse, lifetime of the spouse,
right,
right? It depends. And what about the children's college education? What about the children's school education? So those are the kind of factors that you need to take. You need to calculate that. I have a calculator for it. It is on the SEBI investor portal. People can look at it. You can use that calculator and estimate your life insurance. Of course, typically that will come out to be a big number, 1.5, 2 crores maybe for, and most life insurers will only be ready to give you a cover of anywhere between 15 to 20 times your current annual income. right? So depending on that, you can decide which is acceptable, and or you can just go to them and say, just give me the maximum cover you can give me. But it depends on your health also. If you have health issues, that maximum cover will cost a lot.
Right. The
Because
premiums will shoot up.
many people look at these comparison portals and they decide that's the premium. No, when you actually apply to the insurance, it becomes a personalized thing. They will look
Right.
at your numbers, do the blood test, whatever, etc., and then decide the premium. Finally, only they'll decide the premium. So
Correct.
you have to take all those factors. So if you have an understanding, it's all about understanding the product and why you need it. Then it becomes
Correct.
clear.
Correct. And sir, so if I were to summarize the products that we should be going for, one is a health insurance of a no-brainer. Then there's a life insurance, depending if there are dependents in your family. And the third is your portfolio that you have been creating, which is a mixture of equity and debt. Greater share of equity for youngsters and maybe a little lesser share of equity when you are approaching your 50s or maybe your 60s. That is what I've understood. For the third part, which is your portfolio where you are, predominantly invested into equity markets. Uh, People who might be watching this might be, might be the people who just started investing after COVID, that is after 2020. So they have seen a very good bull run of about 4 years where they have seen their portfolios in green, making 2x 3x returns on some stocks, or maybe making 50 60% returns on the mutual funds. As we are recording this, this is one of the occasions when the markets have corrected by 7 8%. Recently, where we have not seen that in the past 4 years. So my question is, how do we handle these kind of market cycles in terms of because we have not seen any correction in the recent past.
I think some understanding of past risk is very important. And the biggest mistake people do is they look at a fund, they open their investing app, and they look at their some fund return and say this given 35%. And they assume that that's how their experience is going to be. That's almost always never going to be the case. Returns are always going to fluctuate, and they're going to go through cycles of unknown periodicity. And if we look at the past returns, the only thing we are guaranteed of is risk when it comes to equity. The only thing we're guaranteed of is risk. What we have is if we keep investing over 10 years, 15 years, etc., we have a reasonable chance of beating inflation. That is all. There's no guarantee of beating inflation also, but there's a reasonable chance of beating, which is way more than what we get in life. For example, when we join an educational institution for college or get married, there's no guarantee it will work. There's not even a reasonable chance it will work. We don't know. We have to work it. We have to do the work to make it work,
Right.
successful. The same is true for our portfolio also. We have to make our portfolio work. And but equity markets, the past has told us that there is a reasonable chance it will beat inflation. But what inflation? Inflation is the usual 6, 7%, 8% PPF kind of returns. That is what,
Right.
with respect to the Indian market, I would say it's PPF returns. I would
Right.
consider that as inflation. I would say 7 to 8% approximately.
Correct. Correct.
You cannot expect without any kind of evidence, expect 15% return over the next 15 years. Because you say, I have made 25% in the last 3 years, maybe it will become 15% in the next 10 years and so. No, that's not the market has no obligation to give you the return that you want. It will give you
Right.
whatever it likes. And if after 10 years and 15 years, the equity returns are, let's say, 9%, 10%, the market has won. But because it has bet inflation, approximately. But as an investor, the guy who expected 15% has lost
Right.
because they expected 15%, they would have not invested as much,
Correct.
corresponding to a 9%, 10% return.
Right.
And the time lost is lost forever. So for then it's a loss. Then it's actually it's a failure as in terms of planning. So I would say have very moderate expectations from equity and fixed income, both of them.
Right.
Because going forward, if people are going to talk about India shining and India becoming a global superpower, etc., what that means is if you look at the superpowers today in terms of the economically strong countries, they are all paying a very large amount of tax. The personal taxation percentage is very high. even if we increase 0.5% tax, everybody on is, in social media is up in arms. So we are going to have to be ready to face higher and higher tax, pay higher and higher tax over the
Right.
long. The equity market is going to mature more and more, which means the returns are going to fall. Gradually, it's going to fall. Inflation is going to fall. Because inflation is going to fall, fixed income returns are also going to fall. So we have to be ready to expect lower returns in the future.
Right.
No matter what the market, up, whether it goes up or down, I don't care. Over the long term, I'm saying 15, 10, 15, 20 years. So that kind of reasonable expectation, if it is there, the disappointments, like any aspect of life, will be lower.
And sir, in terms of the withdrawal rate, you had mentioned that 3.5% is a good rate of withdrawal. And even in cases where we expect a scenario where we are generating about 9 to 10% returns from the equity markets, this is still 6.5% extra returns compared to our withdrawals. So with this, there's also a very high chance that our portfolio will never go down to zero or will never reduce in value from its previous year's value. So, is it likely the case that we'll be, leaving a very good corpus for our next generations, given that we have such withdrawal rates?
All depends. Very few people will be able to do it because they're spending a lot. Today's
Okay,
young generation, they spend a lot. And
right,
because of that, I don't think, I think it will be, unless they have fire as a very strong goal and they are inherently frugal. Achieving 3%, 3.5% withdrawal rate is initial withdrawal rate is going to be very, very tough for most people. And
okay,
even if for those people who do achieve that, it all depends on sequence of returns. It all depends on where they invested, and it also depends on luck. Depends on how the markets behave, and the kind of movements in the equity buckets that they made, the kind of shifting that they did, how they managed their retirement investments. So depending on that, would be the amount of money left over. Of course, their own health also matters because they may
right,
outlive it. Because
right,
uh, the problem is today we see a lot of young people dying. Older people are, living, carrying on, and it's very ironic, and it's in a way tragic to see so many lifestyle diseases taking hold of young people. But older generation, if they have had good habits, they carry on. And if the money is not enough, then they'll have to, at 80 or 85, if you ask somebody to reduce their lifestyle, it will be very difficult for them. So it's very hard to assume that you will leave behind a corpus. The one thing I've been telling people is, even in retirement, have a source of active income. If
correct,
not passive income, have a source of passive income would be great, but active income, because it will keep you healthy, because you'll be agile, you'll be thinking of something to do, there'll be something next thing to do, and so on.
correct,
And an active income would be a best way to ensure your corpus doesn't erode as much.
right,
So, but for that, they will have to plan. They'll
right,
have to plan this 10, 15 years before retirement of what they want to do. Because everybody will have some skill set. They would, if you are working in a job for 15, 20 years, definitely, aside from the core skill set, you would have got other things also. You would have known this and that. All this can be monetized later on. You can train the next generation. So for that, you need some kind of planning about how you're going to get active income. And not only will you be your relatives will be happy that you're not sitting at home all the time,
right,
and it will keep you healthy, and you will not also erode your cost. So it
right.
depends on a lot of factors.
Maybe they do not work for 8 to 10 hours or 12 hours as we do before retirement, but maybe 3, 4 hours a day keeps them agile and as well as
Exactly.
generates some active income. Right.
Exactly. So it
Uh,
just,
so
occasional freelancing would make a very big difference.
Right. So one last question I have. You started focusing on financial freedom and money management in your early 30s or late 20s, as you said it. What is an ideal age when one should start focusing on this and start thinking about it?
I think, I would say, if possible, parents should teach their children on how to research for products. That's what I always tell parents, that you don't need to start investing as a teenager. Of course, there are many people who do it. There are many people who trade also as teenagers. So that's fine. But do you have the ability to research? So let's say as a teenager, you want to, a teenager asks the parents what they want to buy X or Y product. They want an Xbox or something. Uh, the parent should urge the teenagers to research on the product, find out what is the best bang for their buck. That idea, that research mode should extend once they start earning. Once they start, their careers, if they have that training to do the research before just buying, because many people today, the first thing they will know is they will ask is they won't even know that there is something called the new tax regime where they don't even need to invest anything for ATC. They will ask, tell me something to save tax. There will be the email from the HR. The HR will say, tell us what you did to save tax, or your this will be the tax deduction. You will lose this much money to tax. They'll go, hurry around, scamper around, and ask for X and Y tax saving products, and that's how they make mistakes. They start their
Right.
journey with that. If you had that mode to research, then you will choose the right product from day one. That is probably the most important aspect of financial money management.
I
Money.
think also with the taxation rules that are getting implemented, the new tax regime will become a norm, and the old tax regime should fade out in a couple of years' time. So
Absolutely.
automatically, product offerings and product choices will narrow down for the good, if I'm not wrong.
That is already the case. See, unless a person has a very large HRA component and a reasonably large home loan interest component, both of them together often, the new tax regime is favorable for most people.
Right.
Only for a very small segment, the old tax regime is favorable,
Right.
right? But they still buy tax saving products. I know many people in the new tax regime, they file under the new tax regime, but they still buy tax because that's some kind of inertia. The old mode is very hard to get rid of. So that's where the research comes. That's where the understanding of why you need to do something. What are the risks on the about a product or about a product category or an asset class? That temperament to do research is very important.
Right. I think that is something that everybody should think about and should start implementing as soon as possible. Thank you so much, Pattu sir. I think it was a very, very, very insightful conversation that we had, and very basic points you highlighted. But I think these points are something that people need to implement, and a lot of things for them will get sorted. So I see a lot of people doing their 9 to 3 job and then going in the commodities market and then trading and then coming back to their jobs, and trying to figure out a way where they can maximize their returns or maybe double their capital in a month's time, which generally does not happen. So, but this is the right approach in terms of how you should go about your financial planning and go about your financial independence, and to achieve it in about 15-20 years time. So whatever points you highlighted were absolutely basic yet very brilliant, is what I would is how I would put it up. So thank you so much, sir, for giving your time, for sharing your knowledge, for sharing your experience with us, and being as candid as possible.
Thank you so much.